When selling mass inventory, you have two options to keep track of your cost of goods sold and all of your purchases. When we dealt last week with the specific goods item, where we had very specific items like jewelry, maybe an automobile, where they have their each individual VIN number, you can usually update cost of goods sold pretty easily. But when it's mass inventory, we have two options. If you're a bigger store and you have computers with scanners, you're probably just going to end up using perpetual, which, if you have the option, is the best because your books are always up to date. That's the method we've been using so far, the perpetual method, this first one here on the screen. Because every time we have done a transaction, we recorded not only the sale and how I got the money, or did I get it on account, but I also went down to step 2 of a sale journal entry and immediately recorded the cost of goods sold. And as we were going along, we also would record any time I bought new inventory. But the main thing with perpetual inventory is every time you make a sale, you're updating your cost of goods sold in your inventory by showing that it's gone, crediting your inventory. If you have a smaller store and you don't have the luxury of the computer scanners to keep track of everything in real time, the best method for you may be the periodic method. The periodic method, when you're selling mass inventory items, you can update your cost of goods sold at just one time, and then you, as the store, will pick when that's going to be updated. If you sell quite a few items, you may want to update at the end of every day. If you sell a lot fewer items, maybe once a week is even enough for you to go through and update your cost of goods sold and your inventory account. With your periodic method, you keep track of your individual purchases of new inventory plus any other costs that get included when you buy inventory, just as we talked about last week. Remember, any costs that you incur to get the item to your store and ready to use or sell, it gets put in right into your inventory account, just like it was actually something physical hard that you could touch. Even though you're paying shipping maybe to get the item to your store, that's still counted as inventory, even though you can't actually touch it. So when you're doing the periodic method, the best way to determine your cost of goods sold, since you're not updating it with every sale, is to use inventory as your starting point. And then by using inventory and calculating how much stuff you brought in minus anything that you returned, you can then determine, go back and count how much do you have left and get your cost of goods sold. So here's the equation, and you did this a little bit in last week's homework with Wiley Plus. They give you you're given the beginning inventory, and as you'll see as I go further down, I kind of have a little T account set up to help put some numbers with this. So say we had beginning inventory. We started out this week with $2,100 of goods ready to sell. And then throughout the week, I purchased another $4,500 of goods. And I also incurred $200 in shipping to get these goods to my store. I also noted that I returned a little bit of it, $350 worth. I got a little bit of a discount on my inventory. So when I combine everything, what I previously had with the things that I bought, minus the little bit that I needed to remove, at one point, not necessarily did this ever really happen, but I had $6,300 of goods ready to be sold. So if I know I have $6,300 ready to be sold, and at the end of the week I only have $1,700 left in my storage, I can then easily determine what my cost of goods sold is by simply taking what my little formula up here says, cost of goods sold, or cost of goods available for sale, minus my ending inventory, does give me my cost of goods sold. so it's kind of a little bit of a refresh from last week with our Wiley Plus, but I wanted to show it in here as to definitely show you that there are two ways to keep track of inventory. The perpetual method, where you update cost of goods sold after every sale, which is used probably more often with smaller stores. It can be used with your unique items, but it would definitely be used with your larger stores with the computers. Now, when we're selling mass inventory, we're going to have three new ways to keep track of it. The one we learned last week was the specific ID, where I knew exactly which piece of jewelry I sold. Now we're going to be selling items that are more very mass-produced. They're not original. They all look the same. And when we do that, we have to pick, as the store or as the owner, which method do we want to use? Which one is going to suit us the best? Do I want to use Fifo? Fifo stands for first in, first out. And so how we're going to keep track of that inventory then is the first items that I bring in, or even my beginning inventory. So if I go back up to my original example, the first items in, including my beginning inventory, would be the ones that I'm selling. So these guys are the ones that I'm selling. And then the initial purchases that maybe I bought on Monday. Whereas the items that I bought later in the week, I would still have on my books as my ending inventory, because those guys I still own. When it's FIFO, I'm getting rid of my very initial items first. So all my ending inventory is priced at probably the more current pricing, because that is the most up-to-date, whereas my cost of goods sold may not be quite as accurate because it's selling the older stuff, which very well could be a lower price if you're looking at a period of rising prices, which is probably the most common. The second method we have to look at, the second new method, is Lifo. And that's just the opposite of the FIFO. Last in, first out. I kind of like to think of this one like a cave. If you were to go into a cave and you were at the end of the line, and then everybody decided it was time to leave, and you all just turned right around and walked back out, you were the last one in the cave, but then you were the first one back out of the cave. That would be a Lifo. So the most recent items that were just purchased, maybe even as of yesterday, are deemed to be the first one that I actually sold cost-wise. Therefore, all of my ending inventory has all of the older costs, and if it was rising prices, that would be the lower cost. My cost of goods sold would be more current and maybe reflect better with the current costs. We're going to do examples of these in just a couple minutes to show how this kind of works with just some numbers to throw in. The last method is kind of takes the average of both of them, and maybe this is why this may be the most common. We do it a little bit different when we're looking at how we keep track of our inventory, but it may make the most sense for most companies because it doesn't favor one or the other, meaning ending inventory or cost of goods sold. It just takes a nice average. So with that said here, and we'll explain how to do this with the average cost, but basically what happens is every time I buy new inventory, I'm going to update my inventory and show a brand new average cost for everything. And we'll see how that works. Finally, the last thing I wanted to show you here, as we just kind of briefly touch on this before we look at an exercise, is the good and the bad of FIFO versus Lifo, an advantage or a disadvantage. And this is what I had just previously said. The advantage of FIFO is your ending inventory, which is an asset, is going to be a lot closer to the real cost than if you're using Lifo. So you can see the Lifo disadvantage is the ending inventory, which makes sense. So whatever the advantage for Fifo is will be the disadvantage for Lifo. So your ending inventory or your assets will continue to have those outdated costs. So therefore your assets will be lower than they could have been. Whereas a disadvantage for Fifo is your cost of goods sold. For Fifo here, your cost of goods sold are going to be at the lower cost because they're using the older numbers, the numbers that were originally there. Therefore, my net income may be a little too high because I'm using those old, cheaper items to cost out, to cost. So my net income could be distorted a little bit. Whereas the advantage then with Lifo is my cost of goods sold will be closer to our current prices, which if they're in a period of rising prices, those most recent prices are going to be higher. Therefore, net income will be lower. And a good time for net income to be low is for tax purposes. If you're a corporation, the lower your net income, the lower your tax will be. Okay, that brings us now to our example. We'll go ahead and bring that up. Hopefully you have this out and ready. We have number 27. I'm going to have this 27 up here just briefly, and then I'm going to switch over to the Excel and the answers. So if you don't have this, pause the video at this time and quickly just write out what I have in this little box here of what we're going to be doing and keeping track of our inventory purchases and our sales. And then for each method, I'm going to have us do the sale journal entries over here. So each sale date has a journal entry. And then finally, for each method, FIFO, LIFO, and average cost, we're going to be answering these questions. The total sales, cost of goods sold, and gross profit. How many items do I have left in my ending inventory? And what's the cost, the final cost of my ending inventory as well? And then if we have time, we'll also look at how it might differ for periodic purposes, where we do everything just at the very end of the week instead of at the end of each day or each sale, or in my case, what I have up here, each transaction. Okay, with that, I'm going to switch screens at this point. I'm going to be bringing up my Excel. Here's the Excel. This is number 26, and you'll need a few copies of this as we go through it. What we're going to be doing is every time we have a purchase, we put that over here, and then we correspondingly put it over here into our ending inventory. This is kind of our catch-all columns over here, where we're going to update our inventory, basically our T account. And then every time we make a sale, I'm going to update to show how much of my inventory was needed to leave. And I'm going to put it as well over here in my ending inventory. So you'll need to bring up a clean sheet of this ending inventory worksheet. And we're going to go through how to do this with all three methods. So I'm going to bring up now part of my answers. Okay. So what you can see here, I'll go ahead and put up both of them. The first two purchases from my number 27 chart. The first purchase I had was 100 units. I bought those 100 units for a total cost of $3,000. So then correspondingly, if I purchased them, they're what I have in my ending inventory. If I looked at my T account as of the first day, I would show $3,000. I decide after April the 3rd that I need to buy some more. It's not going to be quite enough. So I buy 300 more items at a total cost of $9,300. And then I do the simple division, just divide out what's the average, what's the price per unit, $31. And then I list it over here, but I do keep it separate. I don't want to combine these. We're going to do that when we get to average. But for FIFO and LIFO, we keep them separate. I want to know which items did I bring in first, so that was these $30 items, and which items did I bring in second, the $31 items. That's going to be important when I'm ready for now my first sale on 4/4. So on 4/4, I come down to my first sale, and I'm selling 350 items. And it also tells me how much I'm selling them for. But what I'm using this chart for, since my original problem already tells me the sale price, I don't need to figure up that. I'm just going to simply list that over here in a second. What I want to know is, since I already know the sale price, how much would the cost of goods sold be? So off to the side here, I'm going to go ahead and do the initial journal entry. So on 4/4, I know what the first entry is going to be. Let's say I sold them on account. Doesn't matter who it's to. Let's bring it down the line. Accounts receivable, and real quickly I'm going to peek and see what it was. 14,000. I sold for 14,000. And then I need to credit my sales revenue. Now we're keeping this one very simple. We're not going to show any tax at this point. But this is how it would look. So that's part one of the journal entry. It's part two that I need to use my chart because I don't know what the cost of goods sold is. That's unknown to me right now. I know what I sold them for, 14,000, but how much inventory? Remember, I have this inventory on my books. How much of that was actually sold? That's where I'm going to use my chart now. So if I'm doing the FIFO method, first in, first out, I know I'm selling these 100 items first. And if I'm selling 350 items, I'm selling all the first 100. Those guys are completely gone. And those items cost 30 bucks a piece. So again, the total cost is going to be the same. Now, if I sold 350, I just took care of 100 of them. That means the remaining 250 came out of the next group. I took 250 out of here, and those 250 items cost $31 a piece. So I put in the 250 that I sold out of that group at what they cost a piece, 31, and then to get this 750, I multiplied the two. 250 items at $31 a piece. So total, here's the 350 I sold, and the total of all of the cost of the goods that I sold, $10,750. So I could go ahead and do the journal entry and update my journal entry with this $10,750. But right before I do that, let's go ahead and show how I got this new ending inventory. So remember, these guys are gone. It's like they never were there. And out of the 300 that I had before, 250 are gone. So I'm left with only 50 items that cost $31 a piece. Therefore, I can then figure out what the total cost of my ending inventory is on my books, $1,550. So I can come over here now, update my journal entry to show the $10,750 that I just calculated, the goods leaving the store. So we move on now to April the 6th. On the 6th, I show 500 new items being purchased. Of those 500 items, it was total cost of $17,000. Do the division, 17,000 over 500 items is 34 a piece. So what I need to do is I need to come over to my ending inventory and add in those 500 items. Now there are two ways to add it in. and I'm going to show the first way here and then the second way on Lifo. You could simply put this $517,034 right underneath your previous 50 here that we just calculated. Or you could skip a line, and every time you skip a line, as you can see that I've done, at least one line, that means you're starting fresh. If I've skipped a line, everything that was up here, once I've skipped a line, that stuff is no longer being carried. I don't need to look at that anymore. All that's left that remains is 50. If I would have put the 50 right here, then it looks like I still have all of this stuff plus 50 more, which is not the case. So here I'm skipping a line, and then to keep everything in nice, neat horizontal order, I'm just bringing the 50 straight down by showing, okay, I still have that 50, and now I'm including the newest purchase of 500 items for $34. And now I'm ready for my final sale. I make a sale, and I'm selling 525 items, is what it tells me in the problem. If I'm selling 525, that means I'm selling all of these, and then almost all of these as well. Now we can start our journal entry again. Give a quick peek. It was 21,000. So on 4/8, I'm going to show an account receivable of 21,000. That was my sales revenue. What I don't know at this point, though, is my cost of goods sold. And how much inventory did I lose when I sold that? That's what I need to use my chart for. So let's go over and finish up our chart. So at this point, I have my 50 items. I have my 50 items and my 500 items. If I'm selling 525, first in, first out, that means these guys are going to be sold. So I need to show that. And then if I sold 525, I still have 475 left that need to come out of this group. The 475 that I sold, and remember they cost $34 a piece. So we do the multiplication here, 475 items at $34 a piece, gives me the $16,150, plus those early items that I sold, gives me a total cost of goods sold when I add these up of $17,700. And if I got rid of all of these, and I got rid of 475 of these, that leaves me only 25 in ending inventory at $34 a piece. So I can finish out my cost of goods sold. I have $17,700 for my cost of goods sold based on the $21,000 of sale price. So a nice little markup there. Now the final piece that I had you do for on your answer sheet is to tell me what is my total sales. So remember, in this middle column where there is really no boxes, it's nothing you had to figure. I gave you these totals, the 14,000 on the first sale and the 21,000 on the second sale. When you add them up, your total sales are 35,000. So that's answer number 1 on that initial number 27 sheet for Fifo. Answer number 2 is my total of all of my cost of goods sold added up. So I had a 17,700 plus a 10,750. So I have a total here, cost of goods sold, when I add up all of that, 28,450. And now, as we learned last week, to get gross profit, we simply take our sales minus our cost of goods sold, and that's where I get the 65.50. That's how much income I have made over these two sales. And then what I had left, I had 25 items left for answer number 4, and those 25 items cost me $850 when I use the Fifo method. Okay, now if you've used half of your sheet or less, you could just draw a line. And we're going to start Lifo on the second half. Lifo takes up about the same amount of room as Fifo does. So therefore, if you've used more than half of your sheet, you may want to start with a new sheet at this point. Okay, I need to get my screen, and we're going to switch now to Lifo. Lifo, as you see, starts out identical to Fifo. So if you need to, go ahead and pause at this point so you can catch up. We have all of the ending inventory. It looks just like it did with for Fifo, but now with Lifo, when I sell the 350 items, I'm going to sell all of the last ones first, and then take whatever I need left out of the first group. So I'm selling all 300 of the most recent purchases at $31 a piece. And then to get to the last 50, I need to take 50 out of the first group. And those items cost me $30 a piece. So 30 times 50 is $1,500. No reason for that to be bold. Maybe this one should be bold. So my total cost of goods sold is simply what I just calculated, $10,800. And at this point, you can go ahead and do your 4-4 journal entry. It's going to be slightly different. Your sale still is exactly the same. I still sold them for $14,000, but now my cost of goods sold is $10,800, whereas before on the other one, it was $10,750. So not a huge difference, but over time that will add up. Now we go to the ending inventory. I still have 50 items of this first group at $30 a piece. Now I'm ready to add in my second purchase. On the 6th, I have 500 items for a total of $17,000, just like what we did with Fifo. And I'm going to add them right in to my ending inventory, just like I did with Fifo. The only difference is I went ahead and put them right next to the 50 instead of skipping a line and and dropping the 50 down, and then so basically rewriting it and then adding the 500. Since this was close enough horizontally, I just went ahead and put it right in there. And that's the other way you can do that. Now, when I'm ready to make my last sale of 525 items, again, I'm going to use the Lifo method, selling the most expensive items first. So I'm selling all 500 of the $34 items. And then whatever I need left, I need to take it out of my first group, which was the much cheaper items, only $30. So my total cost of goods sold for journal entry number 2 is the $17,750. Now again, I'm not putting the journal entries over here. They're going to be just like they were for Fifo. The only difference is we've got a new cost of goods sold number. So now I use 25 of these older items, so I only have 25 left. That cost $30 a piece, so I have $750 in my ending inventory. Now I can go ahead and look at my final answers and then compare, well, how's the gross profit comparing to Fifo. So I have $35,000. Line 1 is still the same, total sales. Cost of goods sold, as you can see, went slightly up. And that makes sense. I sold the more expensive items. I sold the $34 items. And I only have the $38 items left. I have 25 items still on my books that cost $750. So my gross profit for Lifo is $64.50, which is going to be lower. Remember, usually Lifo is going to be lower. Think of L&L, Lifo, and lower when you have rising prices. So $64.50 compared to, it's not a big difference, $65.50 for tax purposes, that could begin to really add up if you're having to pay 30% tax difference. Okay, now the last method that we're going to look at is the average cost. At this point, go ahead and, if you need to pause, get out a new sheet. You probably don't have room on your initial sheet. And we're going to look at how average cost is not necessarily harder. It's just a little different than the Fifo and Lifo. So we have our initial purchase here of the 100 items for $3,000. The new part comes in, or the first item that's new, is when I buy the 300 items on the 3rd of April, what happens is instead of having a separate listing like I did for Fifo and Lifo, I'm going to combine everything now. So I had 100 units plus the 300 I just bought. So that's where the 400 comes from. I had 3,000 in inventory plus the 9,300 I just bought, which is 12,300. And now to get this, I want to do the division. I'm going to take 12,300 over $400. And that shows me that the average cost of all of my stuff was $30.75. The one thing I don't want to see is you taking the average of your two prices. That's not going to work because the average isn't $30.50 as we just showed here. Mainly because I bought a lot more items at the more expensive price. So therefore my average is going to be more expensive than $30.50. Now when I'm ready to sell my first sale, I sell 350 items out of the 400. But now I only have one price to look at. That's where this, or average cost, actually becomes a little easier. Your cost of goods sold and your ending inventory will always just have one line. I sold 350 items that cost $30.75 each. Therefore, when I combine these two, I can determine my cost of goods sold, $10,762. And if I sold 350, that means I only have 50 left. And those 50, I haven't done anything with them. They still cost $30.75 a piece. When I buy a new piece of inventory, 500 items at $17,000, what happens then is I need to add the 500 to my initial 50. So I have 550 items. Add in the 17,000 to my initial cost of inventory. And then again, do the division. I get 3370, and again, that's rounded. So I'm going to try to, I'm not going to use the exact number. As we go further down, I'm going to actually use 3370, which is probably what you'll use on your paper. So when it's time for our final sale, when I sell 525 items, I'm going to sell them and then take them off my books at this brand new average cost price. So I'm selling the 525 items at $33.70 a piece. Actually, that's not what I'm selling them for, but that's what I'm taking them off my books. So 525 times 3370 is how I got this 17,692, which only leaves me, when I sell 525, still 25 items at $33.70. I have well, actually how I got the 845 is when you combine 25 times 370, you're going to be a little bit off due to rounding. So the best way to take care of that, and so you match your TU count in inventory, is to take your old And this is only for average cost and only when there's rounding involved that you should do this. Take your old ending inventory, subtract out what you just sold. That's going to leave you then what you have left, the $845. At this point, we can go ahead and can start comparing sales minus cost of goods sold, giving me my gross profit. And the gross profit should be in between the LIFO and FIFO, and it is. So if we go back to LIFO, so in average cost it's $65.45. Here it's $64.50. Here it's $65.50. So it is in between, but it is a lot closer to the FIFO at this point. Okay, that will wrap up our initial section of FIFO, LIFO average cost. The next video that will relate just exactly with this is going to put this into real life scenarios and combine it with last week's material where we start adding in sales tax, sales discounts, and returns, and how those returns and discounts look on our sheet. So we will do that at this point in our next video.